Hi, and welcome to this week's episode of the CostofCarry podcast. My name is James Chi. Let's get started. Non-bank lenders are important. The boxes are getting smaller and assessments are getting tighter. Now, what I mean by this is that the supply side of the lending market can be broken up into 5 categories: the majors, tier 1s, near primes, specialists, and privates. For most of the borrowing market, consumers and businesses are suitable for the majors and tier 1s because they're able to accommodate their finance needs and their borrowing characteristics. However, the role and importance of near prime and specialist lenders in particular are definitely coming to the attention of different types of borrowers because of the fact that the criteria for the majors and tier 1s have now become somewhat harder to satisfy compared to pre-2020 times. With the types of business and global health events that have occurred and affected businesses, and also being midway through the second quarter of the 2021 financial year, the vetting process for certain borrowers and employment industries is significantly influenced by what has happened with government support and trading activity. For example, you should ask yourselves, can you provide your tax returns and pay slips and demonstrate the strength of your income without any government subsidies and support? How about if you're a business owner? Are your tax portals and BAS up to date? And what are the results of your BAS for this quarter compared to the same time last year? If there are any discrepancies between the 2 or 3 periods, and perhaps your business plan or forecast is looking somewhat uncertain, then in the eyes of a major or tier 1 lender, providing you with credit may pose more of a risk because of your character and credit, as opposed to other things such as location or security, for example, the collateral that's being offered up. From what I've seen, having dealt with the majors and tier 1s, near primes and specialists, there are definitely deals out there that fit the near primes and specialists better than the majors and tier 1s. And this may go against everything that the customer has seen themselves or previously experienced or also seen on TV. And where lending may have been typically available at the majors and tier 1s is now what I'm observing is that some of those deals are now getting declined because of that adjusted lending criteria. And this void that's been created in the market is being filled by those near primes, specialist, and private lenders because of their ability to price risk and also offer more flexibility in their criteria. And when I speak of pricing and flexibility, I'm referring to things such as income documentation, so low doc, alt doc, lease doc type products. We also have adjusted loan to value ratios, what's accepted as security in certain deals, and also credit profiles. So maybe you have a few small defaults on your file, or maybe you've had a adverse judgment placed on your credit file. And these types of lenders can accept those situations from borrowers. But obviously the trade-off for these types of solutions in particular is the cost of entry compared to the prime lenders, and you'll see this with things such as risk fees or increased interest rates. And that again refers to the risk and reward type situation. But this doesn't mean that just because it's expensive doesn't mean that you need to avoid lending in these spaces with these lenders. Because the question then becomes a matter of what is the cost of carrying this unutilized capital or property or missing out on the opportunity to enhance, grow, or develop what I currently have. And depending on how strong your banking relationship is in that case, if your banker is declining credit and previously they were approving it, if this situation starts to get in the way of perhaps your own perceptions of what you want to do in growing your property portfolio or accessing finance, maybe then it's time to reach out to a broker, mortgage or finance, to give you a hand with, getting you in touch or introducing you to new banks and lenders that can hopefully approve your finance requirements. And obviously, each bank has a separate lending criteria, and that's why, it's always good to discuss first with a finance professional before going and, submitting an application. Now, following on from this, I just wanted to touch on something relating to financial empowerment and how a broker can add value to their customer and what that basically means and entails and looks like. So following on, and look, it's not the first time that I've ever talked about this or mentioned this, but the role of the broker is to provide credit guidance and assistance. Now, with the new regulations and duties that are coming into place, the role of the broker can be somewhat adjusted to reflect these changes, whereby the new role, in quotation marks, could almost be considered to empower and add value to the customer when considering their best interests. Or, in considering their best interests, does the solution available empower and add value to the customer? Now, obviously, this is just a blanket statement and doesn't obviously apply to all situations. But with the concepts in mind of financial inclusion, financial abuse, and financial literacy, I think the broker can definitely insert himself or herself into this new definition or role, not only because it's required and it's like almost pretty much what brokers do in the first place, but also because if we're trying to consider providing value and helping, our customers grow, whether that be their family portfolio, their property portfolio, we want to help you. We want to be there along for the journey. We want to, help you get into that new dream home of yours. We want you to help you buy that new car. We want you to help you maybe purchase a new business premises. We want to, part of empowerment and value adding is a long-term process. Now, of course, there are short-term gains, but when we're talking about financial empowerment and how that means different things to different people, if a broker is able to responsibly assist in a customer's journey journey as in a long-term journey, to achieve this state of value and financial access, then it's a job well done. I mean, of course we need to consider short, medium, and long-term impacts as well as long-term impacts. But for the most part, if we're looking at, say, the big picture, which I think is just as important as the immediate short-term vision, then the broker then becomes a conduit between realizing potential and also setting them up to achieve that and unlock that. So look, it's just a thought. It's definitely not legislated like that in those types of words, but it's definitely an extension of what the regulation is perhaps trying to encapsulate. Last point. The fintech lenders and lending landscape who have introduced new business models have kept the major banks and institutions on their toes. The story of the challenger versus the incumbent, it goes beyond just finance, but business is always being disrupted by new technologies and players that are competing for the same customers that the major players have traditionally owned for many years. And in some cases now, with these new fintechs and challenger business models, we're seeing that new customers are starting to emerge that previously haven't existed or weren't identified as being part of the market. So the emergence of fintechs in the finance market, obviously, has somewhat had that regulatory and competition influence on the landscape for customers and also intermediaries, such as brokers, because those value propositions that they have address those pain points that were experienced at those incumbent institutions. And in some instances, it can be observed that these fintechs are either founded, backed, or run by, the incumbent. So the incumbent has a stake in the fintech, or that the personnel and the staff from the incumbent have jumped ship and moved over to the fintech. And I thought this is, and there are some examples of this, but in the, in the spirit of, not trying to draw attention to any particular fintech or lender, you can do that research yourself if you wish. But I find it interesting that why an incumbent would go and invest and challenge their own bottom line or position by giving attention to the fintech. Now, obviously, the incumbent can always acquire a fintech, if that's the case, and thereby reduces the fintech's ability to penetrate the market. But from a customer outcome perspective, if we're seeing fintechs start to pull market share away from the incumbents, then this definitely indicates the trend of moving away from these ingrained and institutionalized relationships that are primarily exclusive to, only a few, a certain section of the market. So as we've seen in, say, not only Australia, but also in North America and China, Europe, India and Japan, whereby mobile-based lenders are providing that microfinance service or digital user experience that provides the access and also has that ability to integrate with other aspects of the consumer's life, such as their social media, their online shopping, travel, telecommunications, and mobile devices. I think it's definitely interesting to see that, a fintech is not only looking to, be a replacement for the incumbent, but also is looking to also integrate horizontally across the consumer's life. So, like I said, not only are they trying to vertically integrate within the industry, but they're also trying to horizontally integrate along the among different industries. So, that's definitely something interesting to see, and that whole concept of alliances and partnerships is definitely something that's, it's definitely a new concept. And just like fintech, the development of such products isn't yet perfect and self-sustaining and self-functioning, but it's still a major step up from letting an institution or a bank almost telling us how we can access money. Now, I think that this is why certain SME, small and medium enterprise lenders and personal lenders are having such a strong uptake. And I think we'll see this soon in the home loan lending space. But once that happens, the major lenders will be, in my opinion, threatened and considered replaceable because, that whole notion of you're buying into the brand, you're buying into the security, all that type of, I wouldn't say fear-mongering among the fintech, but there's definitely a lot of validation that goes into letting a fintech participate in the Australian marketplace. I mean, it definitely just doesn't happen overnight. It's obviously something that takes time, and trust is essential in this process because obviously these fintechs are trying to disrupt a model that has historically been around people putting money in a bank because it is a secure and well-recognized place. Well trusted and reputable place to, store your money, invest it, and that's why those whole institutions have been able to scale so quickly because, they've obviously captured the supply chain and also done the whole spread across different industries as well. So, to have a fintech try to replicate that, obviously at a smaller scale, is definitely something impressive that needs to be looked out for. And on that note, that concludes this episode of the CostofCarry podcast. Thank you all for tuning in, and I'll see you in the next episode.